Good morning, everybody. Welcome to our Thursday Q&A session, where we discuss trade ideas and the market in general. The volatility continues on this side, and it's definitely not an easy market to trade. But today we're touching base with Fiso on his recommendation that he gave on Redefine. He's giving us an update after their numbers. And we're keen to hear what you have to say, Fiso.
Thanks, Zorro. Good morning, everyone. My name is Fiso Mbuto, and I'll be taking you through some of the highlights from our company update report for Redefine. So just on the executive summary of things, so we had a buy recommendation in the last report, which would have been about 2 or so months ago, and that had the first half results for Redefine, and the share has gone up about 18% since then. So what that does is it does put a little bit of squeeze on our current upside, but we do maintain our buy recommendation with the intrinsic value of 460 and the upside of 3%. So reason why, it's more so due to our view that there should be further outperformance driven by continued yield level depression. You would have seen that in the last 2 or so months, the bond yields have fallen by about 100 basis points since the last report. And when we look back since probably the October report, they've gone down by quite significantly more. I'll show you in a couple of charts. But what we're seeing is that we expect it to fall a lot more, closer to that 9.5% 10-year average. And the reason is the yield levels have fallen quite a bit so far, and it has all been in anticipation of the interest rate cuts, and they haven't come yet. So we think that given how far they've fallen already before the interest rate cuts, as we start to see more sort of sentiment towards the cut, we should expect a further depression in yield levels, which would be half of the argument. Half of the argument would be sort of a turnaround in property fundamentals, as we've seen in the last reports, where we sort of monitor the rental reversions as well as the vacancies. So we expect the share price to actually go as high as about 5 Rand 10%. I mean 5 Rand 10 cents, which would be closer to our bull case, and gives us a little bit more wiggle room relative to our weighted intrinsic value of 460. Now, since the last report, we haven't had any material new information that has warranted a change in our view in the intrinsic value of the call, but we still remain optimistic on redefining the sector, and that's why we've kept our intrinsic value unchanged, kept our call unchanged, but sort of want to hammer on the point that we expect a sort of further outperformance driven by sort of an expectation of continued yield level depression. The things that would really change our mind, sort of the two stances that we're looking at here. One part of it is the macro related to bond yield levels. So if that view changed from yield level depression to yield level expansion, then we would start having to rethink our footing in the property sector as a whole, as well as Redefine. And then the other one would be a deterioration in property fundamentals. So the big important thing here is that this is property. We want to know whether people are increasing demand in the space, as well as whether the occupancy levels are increasing or not. And I think since those are the primary things that we look at, sort of the ones where we anticipate a turnaround to come from, and those really would be the main 2 points that would change our minds. So in terms of just a couple of interesting charts that I like to show, so the top left one is quite nice. So you'll see it's a little bit difficult to see in that scatter chart, but the idea here is to sort of illustrate that directional relationship between bond yields as well as price return. You would have seen that there has been a bit of a sort of a shift upwards as yield levels have fallen, and then we've seen the good come up of Redefine since the last report, coming up close to about 18 or so percent. And then when you look at the chart at the bottom left, similar chart, similar idea. The only difference is that it's just showcased more of a line graph. It might be easier to digest, but you can sort of see that the yield levels in the green have taken quite a depression, and then the price to funds from operations multiple has picked up quite a bit. I think it's just important to note that the multiple is inverted, so down is actually good because it means an increase in this instance, and we actually anticipate that as the yield levels depress, the valuation multiple should increase and in turn sort of push us further towards our bull case scenario of around 5 and 10 cents. Then when you look on the right today, you would have noticed, I mean, the whole market would have noticed that being on property in the last, call it 5 years, has been a very, very bumpy road. And even in the last year, but it's just that in the last year, it's gotten a lot better. So you would see that in the red there, it's the old share, the black, it's the sappy, and then I'm in the blue, it's good old Redefine doing quite well. Again, been quite a bumpy ride over the last 12 months, but property has done quite well, and Redefine has done even better than its sector, as well as better than the old share in the last 12 months, which is nice for us. And then these couple of charts just to hammer on some points. So you'll see it there in the top left. All it does, it shows us headline inflation, core inflation, as well as the repo rate. And the idea here is to just illustrate that inflation has been within that SARB band of about 3 to 6%. So this makes us a little bit more comfortable in anticipating interest rate cuts, which would in turn be good for yield level depression, you would see, sorry, in the bottom left chart. We really expect it to get closer to the 9.5% margin. You would have remembered in the report in October, the yield levels were much higher. They were actually over 12%. And then as the pickup of property in the last just under 12 months has been, we've seen property do quite well, and then we've also seen the yield depress quite a bit as well. So because inflation is where it's at within the band, and because yield levels have depressed so far before interest rate cuts, it makes us a little bit more comfortable to expect that the yield level should go closer towards that 9.5%, which would be the 10-year average from this point onwards. Makes us a little bit more optimistic, and gives us a little more comfort in anticipating the upside to be closer to that 15% at that 5 and 10 cent level, as opposed to the current sort of 4 and 60 3% upside. And then just the chart on the left, just showcasing that the price to funds from operations multiple is trading at a premium, but we continue to expect it to go further and further higher, closer to around the 11 times multiple, and even further and further as the yield levels depress. So we'd really start to get more concerned about valuation levels the closer we get to about just over 12 times the multiple, because at least then the upside would have closed a little too much on the base as well as on the bull case. And then just a couple of points to hammer at. So nothing really changed from the last report, because these are all yearly numbers. But you'll see loan to value has improved slightly over the last 5 years. But we have to remember the property is a very geared sector, so you would never really expect 0% LTV. But what you really want is more stability, if not a bit of a decrease. And that's what we've been seeing on Redefine in that top left chart. And then interest cover ratio as well, over the last sort of 4-ish years, has been just above the 2 times, which makes us a little bit comfortable with the 2 times rule of thumb. And then the segment split, I think that one is always interesting and important to bring up because one, Redefine has exposure to office, quite a bit of exposure to office, and office hasn't been a particularly well-performing subsegment of property in the last 3 or so years. But it is important to note that Redefine's exposure in office is more so in A grade and P grade office spaces, which has done a lot better than other office spaces. So that makes us a little bit more comfortable about their exposure. And then there at the bottom is just speaking to vacancies. Retail vacancies ticked up higher over the last 5 years, but still a manageable number. Sort of a similar story with industrials as well. And then office vacancies doing nicely over the last 3 or so years, just decreasing. So we expect, because of Redefine's exposure in P and A grade office spaces, that vacancy number should begin to stabilize and make us a little bit more comfortable. And then when it comes to reversions, which is one of the interesting bits, so that speaks to how demand looks for the property spaces. Retail reversions still negative, but getting a lot less negative. So it speaks to improving demand. And then similar story with industrial reversions as well, which are on the positive side. So that one, sub-segment of property has been doing quite well. And then we've got office reversions a little bit better, but still on the very negative side of things. But we anticipate sort of stability based on Redefine's composition of office spaces in its portfolio. And then on the valuation side of things, again, just sort of illustrated visually there with the chart at the bottom where our bear base and our bull is. Again, even though our base case has about a 3% upside, we're still very bullish on property. So we really expect it to move closer to that 5 Rand, 10 cent side of things, with that 15% upside. And really, the big main points there is we expect yield levels to continue to depress more than they've already depressed prior to taking into consideration interest rate cuts. We've seen that the inflation has been within the SARB's 3 to 6% target rate for a while now. So that makes us a little bit more comfortable with expecting rate cuts. So that makes us a little bit more optimistic on where yield levels will go. And really now we're anticipated to go closer towards that 9.5% from about 10.5% right now, which pushes us to be a lot more optimistic and retain our recommendation at buy and our intrinsic value unchanged, but a little bit more optimistic based on where yield levels are going and where we anticipate the fundamentals really to pivot towards. So that's more positive. Reversions as more controlled levels of vacancies. And that's it from my side. I'm just going to hand over to Sean to take you through the technicals. Thanks.
Oh, thanks, Yuzo. Very comprehensive fundamentals there. Yeah, looking at the technicals, you see that's a graph of Redefine until yesterday. Yesterday's close. The share price is trading far above all its moving averages. So obviously the medium term and the long term trend is bullish. You can also see that it has broken out of that narrow trading range recently. And it's trading above that what I call a short-term support trend line. This morning I see it's up to 1.57, so it's trading at 452. And as Fiza said, our intrinsic value is at 460, but obviously the bullish case is still 510. So yeah, still good buy recommendation on the share. In the short term, I would watch out for that breakout below that short-term trend line, support trend line. That would trigger a change in trend, maybe on some profit taking. We could then expect the share price maybe to pull back into that, pull back on some profit taking back into that trading range between 438 and 412. Should that support area not be held, I would expect the share price maybe to pull back to the previous support around about 4 Rand and then possibly 373. That would be a great buying opportunity. You can also see there at the bottom the MACD indicator, the oscillator, that is trading above its zero line, above what we call a overbought territory, but it's still trading above its trigger line with no clear bearish signals yet. So yeah, that's how I see the chart right now.
Thanks, Sean. Thanks, Fiso. Yeah, if you are back to the chart there, I just want to make a comment.
Okay.
I differ slightly from Sean's view.
This chart.
I don't think this thing's going to pull back. I mean, if you look at the left-hand side there, going back to February, March, April, it was in a sideways market. When Fiso and them gave the buy recommendation in June, it was at the support levels. And obviously it's popped. It went above the resistance level. It made 3 new pivot highs, and now it's broken out again. So I think Fiso's right. I think there's more legs in this. Nice trade, nice recommendation, Fiso. Yeah. This was a good one. Okay, let's see if we have any questions from the audience. I'm going to pop into the chat. Cloud says, thanks for the great presentation, guys. There's no other questions. Anybody wants to ask an outright question, guys? Let's see. Yeah, Fisa, I think it was comprehensive, but it's good to note that, I mean, the market's pretty much discounted a cut in rates, which hasn't come. So these property oaks would get a boost from lower rates because obviously they sit with finance on some of the properties that they have. And when those rates actually drop, then I think they're gonna run some more. So I'm totally agreeing with you that I think this thing's got more legs. Let's have a last look here. Vessel says thanks. What's the company that will be presented next week? Sean, do you know?
I think
I
it's
haven't checked.
I think it's Nedbank. I see Piers here. Maybe
Okay,
Pierre
so
can
then
confirm.
we'll be with Pierre doing Nedbank next week, yeah. All right. I don't see any further questions. Richard says good presentation. Yeah, there's nothing coming. So Fizzo, thanks very much, mate. Very comprehensive, insightful. Thanks very much. Sean, thank you for your bit. Much appreciated. Have a fantastic week, guys. Cheers.
Thank you. Cheers.